the Director of Development in our office. So, my main role is really supporting, Moshan, as she's making this career transition, working with this very old, very well-known, very prominent company. Having you all know that she has a lot of resources, a lot of team members that are here to support, as she's building her business and really giving you the education and resources you need to, have good retirement plans, have good estate plans, and take your financial planning and maybe utilizing, what she's looking to build here as a community and really giving that back first and foremost. So I look at myself as a glorified teacher. I've been in this role for many years. And my job today is to help educate everyone here in this room in terms of what we do at New York Life to help with retirement planning. You're going to hear from our advanced planning consultant and our corporate vice president, Angela Weather, more on the estate planning side of things, right? The legacy estate plan and documentation as well. My job today on retirement planning is sharing with you how we help clients with retirement planning with different accounts, talking a little bit on the taxes and different tax implications there, and giving some history, right, in terms of what services and options you can work with us on there. Giving a little bit of background on this. I don't know if it's the. All right. Good thing I coached the soccer team, so I could talk loud. So I'm gonna go ahead and move forward here. Again, thank you all for being here. Welcome. Really, the two things I want to spend some time on when it really comes to retirement planning, investments, taxes, and savings. Protecting your assets, right? Which is the monies you're putting aside, the types of accounts that you have, and protecting both for the good and the bad, right? And when it comes with that protection, managing risks and taxes along with that. That is something when we do holistic planning here in New York Life, and said another way, building money, generating wealth, or taking dollars, turning it into income. We have one perspective of managing risk, right? Some of our clients, have a different perspective of how they want to risk their assets, and other clients have a perspective around taxes. And we kind of take both of those approaches, and for everyone in this room, it definitely can be a little bit different. Want to start with just some of the savings aspects of it. And ironically, right, 33% of workers today, they feel less comfortable with the savings that they're doing with retirement. And that is one sweet spot with New York Life. We do have a number of large group businesses that I myself actually go into businesses and educate employees. What benefits do you have at work? How can you take advantage of those benefits? Checking off the right boxes there. And for a lot of employees at the workplace, they might need more, right? And having that person to go to really ask the right questions, put the map on the table, and really identify what's the great accounts, plans, both short-term and long-term for them. So, a couple of things to think about, right? If we all knew, how long we would live for, right? We'd probably want guaranteed income to last us to that lifetime, right? We look at those like the pension plans that are out there in today's marketplace, I hate to say it, right? If we all knew when we would pass away, we would probably get life insurance the day before, right? Pay the least amount, get the largest amount of coverage, and, then being able to have a large estate to pass along. Or, if we all knew, right, when the market was going to go up, right, that golden ticket, right, we'd all invest at that right time. So what we look at here at New York Life is, how do we take those positive goals, those planning opportunities, and turn that into something that is not a challenge for you? Because there's a lot of challenges that go about that. For instance, how do I begin to invest and save my money without losing control? I was at a couple of conversations earlier of making sure that my money that's in that place, if I want to use it afterwards, I'm not spending that money down, so I don't want to lose control over that. Losing the principal dollars, right? Maybe the lump sum I put aside in this account or in this plan, I don't want to lose the aspect of that, right? Said another way, I don't want my account to be zero, right, in the next 20 to 30 years and spending those dollars down. And that is a challenge that we see a lot of times right now with those that are looking to retire or have different retirement planning accounts. And then, of course, what's the trade-off of that? Well, I want to invest. I want to have large returns. I want to save tax-free. And I want to make sure that I know that my money is working there for me. So that's what really we spend a lot of time doing. And, again, having conversations with our clients. And first and foremost, what is your risk tolerance? How much risk do you want to take, whether it's in the market, whether it's with fixed accounts? There's a lot of different perspectives on investments. And that's something we're working with Moshan and the team. What is your risk tolerance? What are risk tolerance? What are some investments you may or may not want to be a part of? And that's really on one side of the spectrum. The other side of the spectrum is taxes. And there are different vehicles that maybe will give you great advantages on the pre-tax side, where I'm able to save now, pay less taxes right now, knowing that down the road when I start to take out some of those monies, I'm paying taxes later on. Right? But then there's also different accounts or plans where maybe paying the taxes now and actually having the growth be tax-free. And that's what you see on the right-hand side, the tax mix. Well, I'm going to talk about a couple different accounts where you have great advantages on the pre-tax side and great advantages on the post-tax or after-tax side. So we talk about protection, and then we talk about growing. Right? A lot of clients right now that are working with us, especially going into retirement, spending 20, 30, 40 years saving in these retirement assets. Now I'm looking to retire. I don't want to work anymore, but I want to make sure I have income, and making sure I protect that income. We call it that safe money. Or maybe we have that income last a legacy. I'm a proud father of two. Don't tell my daughters they're taken care of, right? Very well, right? They don't know it yet. But at the same token, what does that picture look like for you? And this is right around the time where clients work with us. They really think about my retirement picture, those next 20, 30, maybe even 40 years. And then do we want to have some investments along with that? Are we looking to still grow assets? And again, in retirement, a lot of clients have different perspectives. Some clients want still to have what we call market participation. Invest in the market. I see some opportunities. I still have 20, 30 years. I'm not working, but I'm still on this earth, and I want to capitalize on my investments. Certain clients, they don't want anything to do with the market. I'm retired. I want stability. I want guarantees. I want safety. So that's where, again, working with Moshan and the team, for everybody in this room, it could be a little bit different. So we'll have an analysis to say, how much investment tolerance, what's your risk? If you put $100 a day and you lost it all tomorrow, are you okay with that, right? And for everyone, it could be yes, no, maybe. That's one part of what we would look at working with you all on, is how much risk would you look to want to take on? And then based off of that, how much in taxes are we able to save, maybe pre-tax or after-tax, and looking at certain investments to be able to help with that, right? So ultimately, my goal here today is, hopefully engaging with all of you on some retirement planning discussions, and working with many clients over the years, making sure you have time for yourself. I'm a sports guy myself. I would love to spend a lot of time in that long-term retirement out on the soccer field or out on the golf course or on the basketball court, one of those three. So I want to be able to have my family the luxury to afford that. And what I can put in place now is maybe going to help me get there. Maybe some of you have some family time, hobbies, or travels that you want to encompass. So, sitting down with Moshan and myself and the team, we'll have some question and answer. We'll kind of take a look at what does your retirement picture look like? What do you want to do? What's going to be your lifestyle and hobbies? In the industry, we call it our standard of living. Right? What's going to be your standard of living in retirement? That could be a lot different than what it looks like right now. So again, right, everything that we discuss is a little bit more general based. But in those one-on-one discussions with Moshan and myself and Angela Weather, what's your retirement picture really going to look like, and how can we bring that together? So when you're out there participating in your hobbies, traveling, having those family vacations, you're not worried about your income. You're not worried about your assets, your investments. How much am I paying in taxes this year? And that's a lot of the things that we can spend some time just one by one, really giving you that advice. And once again, here in New York Life, we provide holistic advice and guidance. So, that could be very different for every single one of you in the room. And that's why I really love what I do, right? Because I get to have those one-on-one discussions and, get to identify, when do you want to retire? How much income do you want to retire with? What assets are going to help you get there? And then let's make sure everything is in place, right? Crossing our T's and dotting our I's, right? So, some of the challenges that we see in these next couple of slides, I'm going to do a little bit of a history lesson of, what retirement planning used to be, even 20, 30, 40 years ago. I'm going to also take a little bit of a deep dive into what taxes used to be and just give a good expectation of what we see in terms of planning options and even some products that might be good opportunities for you to look at here. So, looking at what retirement used to be, a lot has changed, right? in terms of how we can save. I'm sure if I asked those of you in the room, how many of you have pensions with your employer, with your companies? I have been seeing a lot of companies, especially in the private sector, where they're not offering pension plans anymore. 40, 50 years ago, predominant retirement savings was through your pension at work. Over 80% of privately held companies had pensions between 1965 and 1985. So over 80% were offering pensions to those clients. And if you weren't getting a pension, you were contributing to Social Security, and then you had some personal savings. And that was the retirement picture. A lot has changed. Less than 4% of companies, as of last year, offer pensions to their employees, privately held companies. A lot of change in the Social Security landscape, right? Between taxes, between funding, right? A lot of different landscapes there. So unfortunately, a lot more reliance is put on you to do retirement savings on a personal side, because you don't have that guaranteed pension at work. We might not have the contributions that we would aim for Social Security. So now you have a lot more personal savings, where most guys and myself and the team, making sure you're putting your money in the right places for your retirement income. Because a lot is put on for you, and unfortunately, New York Life does see the need for us to go into these businesses and educate employees on how to save better, right? We call it the financial planning 101. So when it comes to retirement planning, that has been a big change that we've seen. And I'm sure a lot of you in this room are doing a lot more personal savings now than you probably might have done, even 10, 15, even 20 years ago. So personal assets are crucial, right? And a couple of questions you might want to look at, am I saving enough for what I need to, right? Will my money last? Where is my money going to come from? How much risk am I taking on with my monies? And the $1 million question, how much is it going to be taxed, right? So in those personal one-on-one discussions, we're going to look at everything, ladies and gentlemen. Where are you currently saving? Where do you want your monies to go? And again, looking at your investments and looking at your taxes. How can we maybe meet your goals of how much money you want to risk and how much money you want to be able to save around taxes? And there's benefits to both sides of the coin. That's why I really do love working with the company, right? We are not, pigeonholed into one direct place or one direct product. Even on the investment side, we have over 15,000 funds that we can offer outside of, looking at investment perspective. So, making sure that there are people, there are individuals, you have financial professionals to help you with some of those personal savings, right? So when it comes to savings, spending a lot on the investment side, I want to change into taxes. We were having a discussion earlier on, where taxes were and where taxes are potentially going. Now, of course, we don't have a crystal ball, right? I would love to identify, hey, here's what the tax rates are going to be in the next 10, 15, 20 years. What we do know is we can look back, and we have changed our tax landscape many, many times. But what you see on your slide here is what the highest income earners and the highest tax brackets were, dating all the way back to the 20s. Unfortunately, New York Life has been around for a while, since 1845. I do get the question. We have paid claims during many of these great wars, Civil War, Great Depression, things of that nature. We were paying claims on battlefields there, which is ironic. But as an old company, we have a lot of statistics when it comes to taxes we look at. And as you can see on your screen here, we are unfortunately in history, right? History tells us we're in a low tax rate environment for two reasons. Number one, what you see on your screen is the highest marginal tax rate for those high income earners. So, folks that were in retirement income earning years, right, where they were working, saving, trying to put monies aside for their retirement savings, even in the 70s and 80s, some of the highest marginal tax rates were 70, 80%. So could you imagine, right? I'm saving I'm earning $100,000 and 70 and 80,000 of that is going to taxes. So during that era, does anyone know the number one, arguably one of the number one retirement saving vehicles at the workplaces? It's three numbers and a letter. Does anyone know when it comes to retirement accounts?
401k.
401ks. And the reason the 401k got adopted in the late 70s is because people that were at the workplace earning income were paying a lot in taxes. So how can I, after tax, save? So they created the 401k to say, hey, before you pay your taxes, because we know we're in a very high tax rate environment, let's save pre-tax. right? With the idea that we're not going to pay taxes now. We can invest it, grow it, accumulate that money for you. And then down the road, when you do retire and you start taking that money out, now we pay taxes. And if we look at the chart here in the 70s and 80s, the folks that were saving that pre-tax account, they definitely made out, right? They weren't paying taxes in 60, 70%. Now they're paying taxes, 39.5%, highest tax and marginal tax rate. So our tax top to bottom, highest tax rates. We are at arguably one of the lowest tax rate environments when it comes to those marginal rates. And then what you see on the green, right, that green line that's going up, that is our U.S. nation's debt. And we know where that's continuously going. Unfortunately, no future ball in terms of where we think that's going to end up, but we know there's a direct affiliation with that and where tax rates have been. So when we look at the different tax rate brackets, we went from over 26 different brackets. And what you see on the left-hand side, from 1978 to 1980, we had over 26 different brackets based off of how much income you've earned. That has now been tapered down to about 6 to 7. And that has also directly affected, for some individuals, paying more in taxes now than they were, and nothing has changed in their workplace environment, but we've changed the tax rate environment. So why am I having this discussion with you all? Because when it comes to saving for retirement, is knowing where to put some of your monies when we can potentially be able to save better on taxes. Now, again, the benefit of that 401k is that I have the option to save pre-tax, and I'm not paying those taxes now, but I can pay those taxes later, hopefully at a lower tax bracket, hopefully with less income that I can lower when if I would go back, I can lower my marginal income to pay less as a total amount of taxes. And that's a great strategy. But to be able to diversify, said another way, what if taxes go up? I could have paid taxes today at, let's call it 35%. 10, 15 years now, I'm not paying taxes at maybe 40 or 50%. So what we look at, and we have, we'll call it 3-bucket approach. And there's 3 different asset class types that are matched with taxes. First on the left-hand side is our taxable accounts. And I have a few examples on the next slide that I'll go through in a minute. But you think of your taxable accounts, accounts that you pay on taxes every year, right? If anyone does any investments, those dividend INT statements, any interest-bearing statements, if I have any accounts that I'm rolling over on a quarter-by-quarter basis, I'm paying capital gains tax. So accounts that I pay taxes on real time right now. And maybe you have some money that are going into those funds, which is great. Maybe in the middle bracket, right? Tax deferred. I'm not paying taxes right now. I'm deferring that tax later. And then when I decide to take those monies out, now I'm paying taxes on that rate. So whatever that rate is, or whatever my income is there. We brought up the 401k plan, right? That one of many different instruments that you can use on a tax-deferred side. Then we have tax-free. And in my years of working with New York Life, not as many folks truly understand the tax-free component. And this for retirement plans. There's 3 direct assets where I'm able to save, accumulate wealth, and when I decide to take those monies out, it is 100% tax-free. And again, part of what we can support you on for us as a team is wherever your assets are, wherever your savings. This is a snippet, and we do have a worksheet that we love to walk with you all through, just to identify where is your savings, where are your asset classes, and that's going to help us put a retirement planning proposal for you based off of your risk and based off of those tax plans. But as a couple of examples, what we'd love to spend some time with you on is, first and foremost, how much percentages is being taxed now? How much percentages is being taxed down the road? You're not paying taxes now, I'm deferring it. And I'm gonna pay taxes later. What percentage of your savings is going there? And what percentage of your savings is going to tax-free income? Because now, you retire tomorrow, right? You still need income, and you're gonna be pulling income from those various sources when it comes to retirement income. So now we can also help put a proposal together. Say how much of your income will be taxed, and is there an opportunity to reposition some of those assets? Sir, I know we were maybe looking at like a Roth conversion as an option, right? And maybe having some opportunities to be educated on what we can do, and you make that decision of what is the best situation for yourself, because there's a lot out there. There's a lot of different products, a lot of different assets, right, based off of those risks and taxes. So the good and bad news is we have a lot of those here at New York Life. The bad news is we don't want to put a square peg in a round hole. right? Making sure we understand what is most important to you, what you want to accomplish when it comes to your retirement income, and then really putting that picture together. Because there is no perfect picture. Unfortunately, Uncle Sam is a little smarter when it comes to tax savings, and I wish I could share with you today, team, that you can put monies into a plan where you can defer those taxes. Those contributions are tax deferred. And then I'm not paying taxes along the way. And then I take my money out, 100% tax free. I've done dozens of seminars, and I always bring the question: if anyone knows an account that does this, I will retire tomorrow. I will leave New York Life. I have my many years of experience, but what we look to do is what can we do in a combination of maybe two of those three types of plans, and a lot of different products that are out there, a lot of different opportunities. So what we look at is we say, based off of your goals, your retirement time horizon, how long until you want to retire, right? And then when we retire, how long do we want to give you income for, right? How can we plan around that? We're going to take a look at a number of different assets. And as you see on your screen, here's just one of many where we're actually, when it comes to the tax side, we're going to break down what accounts can we maybe take advantage of that we were able to defer those taxes. What accounts that maybe it makes suited sense to pay the taxes now. And do we have some plans that we can build some tax-free income for those of you here, right? And I always get, the question here, what are some of those tax-free options? Has anyone in this room heard of a Roth account, Roth IRA, or Roth 401k? That's one of those tax-free vehicles when it comes to an investment, right? Municipal bonds, right? There are certain municipalities where you can invest in, and the interest that I earn is 100% tax-free, plus my principal, which maybe could be an opportunity there too. And then cash value life insurance, specifically, cash value paying policies, where now I have cash building into the plan, right? We call that equity inside the policy, and I can borrow and take money out of that policy, 100% tax free. So again, maybe for some of you in the room, it's a combination of all these assets, or maybe for some of you, it's one or two of these assets, and that's where Moshka and myself and the team just figuring out exactly what could be the right suited solution for you. Now in New York Life, we do a lot of life insurance planning. We typically lead the industry in our life insurance suites. And when it comes to retirement planning, we always have that question brought up of looking at a whole life, a cash value policy. I'm an accounting major, right? So, a 770 or 7702 plan, that gives you the ability to use a cash value policy, take monies out of it, and that monies while you're living is still tax-free. And having that be, one of those approaches to diversify when it comes to saving for retirement. Now, I wanted to give a quick example in a couple minutes. I'd love to open up for a few question and answer before I bring up Angela Weather here in a few minutes. But here's an example on the left-hand side, of someone that is now retired and they're collecting $100,000 from their retirement accounts, 401k, 403b, IRA accounts, 457, all those retirement planning vehicles that are out there in the industry. Said another way, it's a qualified plan, right? Qualified account, where I have to pay taxes on all those incomes. So now, I probably could have used my point right here, right? But $100,000, all of it taxable. So I'm in that 22% marginal tax rate. So I pay the tax on that 100 grand. So I'm after tax earning about 78,000 per year. So what we look at is, would there have been an opportunity for the same client to diversify their income and simply say, pay less in taxes? So now the client over on the right-hand side that did decide to diversify their income. Now, when they retire, they're still receiving $100,000 per year, but only 50,000 of those incomes is coming from that qualified asset. And of course, I still have to pay taxes on that qualified asset. So I'm only now paying taxes on 50,000 of income, and that will lower my marginal rate to that 12%. So now I'm only paying a $6,000 tax on the 50,000, because I'm only taking out 50,000 of it. Where's the other 50,000 coming from? Cash value life insurance policy, a Roth IRA, Roth 401k, tax-free municipal bonds. Outside of that, if anyone has any kids in the room, the only asset that could potentially be saved tax-free, some of you might know of 529, it's college saving account, right? Where I'm able to save for college on a tax-free basis as well. But here for retirement planning, I can't use that account for retirement accounts. But now I'm taking the 50,000 out of one of those three vehicles. I'm not paying taxes on that 50,000. So now that same client after tax is walking away with $94,000. So this strategy that we call New York Life is tax diversification. Is there an opportunity to maybe reposition some assets, maybe reposition some of your savings over the next 3, 5, maybe even 10 years to maybe give you some tax-free income or diversify your income when it comes to taxes, right? And a couple of things I do want to close with when it comes to life insurance plans. I always get, what are the tax benefits when it comes to a whole life, a cash value, cash paying life insurance policy? And you get 3 tax benefits when it comes to a cash value policy. First, as I'm saving inside that policy, it's tax deferred. So you're going to see, some of your policies, and some of you may have permanent policies that are growing every single year for you. I'm not paying the taxes on the growth. That's one of the benefits. When I do decide to take my monies out, as long as I keep the account active, the policy active, it is 100% tax-free, right? I put $100,000 into the policy. There's $300,000. I take out $300,000, not paying taxes on that extra gains, right? Which is one of the great tax benefits. And then, of course, it is a life insurance policy. So if that time comes where after even I've taken my monies out and there's still a death benefit or a legacy benefit remaining, that also is given to your heirs tax-free. Those are 3 of the tax benefits that you get with a permanent policy. And then you get some guarantees. The premium is guaranteed. So as I'm putting my money aside, let's say for even 5 years, or for certain cases, maybe 20 or 30 years, that premium is guaranteed. You also have the guarantee of growth. So a part of that cash value is growing in 2 ways. New York Life pays a dividend every year. So as we pay out a dividend into policies, you're getting that as a tax-free growth. And then we have guaranteed interest rate, average around 2%, 2 to 3%, where no matter what, you have guaranteed growth inside these policies. And then, the last, benefit that you have in terms of guarantee is that legacy benefit. Now, when I usually talk about this, when it comes to retirement planning, my clients aren't too really excited that I have a guaranteed legacy because they're not using this as a legacy benefit. They're using it as a supplement for retirement income. But nice knowing that a part of these benefits that I have, this is one of those added pieces to it as well. So with that being said, again, New York Life, been around for a very long time. We're AAA rated across the board. I have 2 little girls in school. They come home with, AAA rated report cards, right? Those scorecards, which is great. So New York Life's been around for a really long time. And because of that, we have a lot of products, a lot of solutions, a lot of different options to show. You're going to hear from our corporate vice president, our advanced planning group, in regards to estate planning. And even looking at, how do I plan for that legacy in the state moving forward? But I just want to thank you all for the time here this evening. It's really been a pleasure to be here with you all. And the next steps, what can we do? What we can support with you on? Again, I know, Moshkan, thank you as well for having us be a part of the group. And, our goal is providing you education, giving you, if some of you may just have some questions, some ideas that you want to bounce off of us, we're going to support you with that. And I think every one of you should have one of the seminar evaluation forms. Love to have your feedback. And if there's topics that you want myself to discuss with you on, I would be more than willing to be a part of those discussions when it comes to saving around retirement. What can I save better with? I have these plans. Take a look at it for me. What can I do? We're here to support that. So, I just want to thank you so much. And with that being said, I want to bring up our advanced planning group and, our estate planner, Angela Weathers, to take the next part of the discussion. So, Angela.
Well, good evening, everyone. I'm very happy to be here. And my role at New York Life is to support you and the advisors in the area of tax and legal planning. I've been a lawyer for 30 years. Before I went to law school, I worked as a CPA at a large accounting firm. So with all that experience, today I'm here talking about this concept of estate planning. And if I asked all of you to turn over a piece of paper and draw out exactly what would happen if you passed away today, my hope is that you could do that with a good sense of knowing that that is what would happen. So I do this periodically. I take a plain sheet of paper and I draw out, if I pass today, what happens to the things I own? Who receives them? How do they receive them? And is that what I really, really wish? It is a challenging question, but it's an inevitable question. At some point, everything we own will be owned by someone else. We have an opportunity to do that intentionally. We have an opportunity to do that in a legal format that can save not only taxes, delay, but also just really stress on the family. I talked to a gentleman today. His father passed away 2 years ago. They are still in California probate court, still don't have a full court order to distribute the assets. Now that is a situation that I see far too often that could be avoided with what we call an estate plan. You all have an estate plan. Either it's legal, formatted, or it's default. The default estate plan said, I died, I had no legal documents. The state of California will say who gets my assets and how. Now, the state of California law is quite old, and it is very clear that if I die with a spouse, they get part. If I die with children, they get part. If I don't have a spouse or children, my parents get it. If they don't get it, my siblings get it. There's no wishy-washy. That will be how your estate will be distributed. The family discussions won't come into discussion with the judge. Religion, culture, not part of that process. The California law will dictate. Now, that won't always line up with what we want. So in the US, here in California, we do what's called an estate plan. And I'll talk about the estate plan because I really, really encourage all of us to have this internal decision and then talk to our families. Because I worked in probate court, and it is quite sad when the family can't agree. The number one litigation in California probate court is sibling disputes. Do you know what they're arguing over? We don't want the house. You take the house. I don't want the house. Because California now taxes those houses. They reassess the property tax. So the kids are in those houses that have been in the families for many years, or real estate, or sadly businesses. The businesses are really, really crucial to have a plan for. Statistically, and this has been the same statistic since I've been doing this for 30 years, only about a third of family businesses succeed without a proper plan. Now that's what we do at New York Life. We help articulate that, get it drafted out. You can work, of course, with your other advisors, your attorney, your CPA, because it has to be a synergy plan. It has to work across all the planning modalities. So that's really what we want to talk about today. So just kind of starting at the beginning, what is your estate? If I asked you to draw it out, what is it? Well, an estate is everything you own. So your house, your car, your shoes, your clothing, your businesses, your 401ks. So all the assets in your name are owned by you. That makes up your estate. So the estate in the United States is crucial because in the US we have what's called a federal estate tax. We do not have it in California, but on the federal level, it says that if I pass away and my family adds all the assets that I owned at death, and it's over a certain dollar amount, the federal government will take 40%. That dollar amount in 2026 is $15 million per person, 30 per couple, if you leave everything to your spouse. If you don't leave everything to your spouse, you only get your 15 million. Now, where we see this quite a bit, it gets overlooked often because what you own would include, in our world, life insurance. So if I own a life insurance policy, that is an asset listed in my estate when I die. Even though the money goes to the beneficiaries, it's still counted in my estate. So that's why it's really helpful to work with advisors and persons like myself, because we deal with this every day. So I would kind of know the nuances of this. It is a full-time job. When I worked as a lawyer, full-time job. When I worked as a CPA, full-time job. When I work as a New York Life advisor, it's a full-time job. Our products are very advanced. The laws continue to change, and we want to make sure that how you are articulating who you want your assets to go to and how actually happens. And sadly, even if you have an estate plan, just time and life events can make it obsolete. So we often recommend that you review your plan every 3 to 5 years to make sure that it still works with current law. Right? I looked at a plan the other day, it was 20 years old, and I looked at the document and I kind of smiled and I said, we don't even use this font anymore in estate planning. It just, times have changed how we draft. And so we are certainly here to help you review your plan. Now, if you don't have a formal legal plan, as I mentioned, when you pass, the state of California will have your heirs, your family, open what's called a probate. A probate is the California court process that determines who gets your assets. You cannot control that from the grave. So you cannot tell your spouse or your kids, you get a third, you get a half, you get the rest. You can't do that from the grave. If you haven't done that in a formal document, state of California will say who gets what. So you do want to take that into consideration, because what's left out of state of California, charitable gifts are not listed there. Other family members, not listed there. So you want to make sure that you have a legal document. Now, I will say that estate planning, as I mentioned, is the right property to the right people in the right time. There is a nuance in the state of California, which is called community property. So in state of California, I'm from South Dakota originally, and then I moved to Texas, and now I live in California. So you can hear different dialects in my voice. But in California, we are under what's called community property. So if you're married, the state assumes half and half. Even if you are the breadwinner or you're the business owner, the state of California will presume each spouse half and half. So if there is a separation, a divorce, or a death, it's half and half. Now you can get around that with a prenuptial agreement, but the courts are very strict on that. So that alone may not get your assets to whom you wish to have them go to. So we want to make sure that all the plans are in place before we pass. Now there is a myth out there that only the wealthy need an estate plan, but as I mentioned, we all have an estate plan. I can tell you clearly what will happen if I pass away, where my assets go. I don't only have that in a legal format, I've communicated it to my family. And they roll their eyes because they hear me say it about every year, usually around my birthday. And I say, you will hear this again because it might change. So you want to listen, and they sit through it. And now I have a daughter who's 23, and I've had her create her own estate plan. It's very crucial because as Matthew was going through, we worked so hard to save our money, mitigate taxes, build wealth while we're alive, then we really want to decide where it goes when we pass. Otherwise, honestly, I've seen estates cut in half or even more without planning. And unfortunately, it can be an expense that the family doesn't know how to pay. It's a timely expense, so what they do is they sell assets or close the business. And we want to avoid that because we want not only our wealth to pass to the next generation, but even maybe the next generation or other charitable gifts that we'd like to give. So we certainly want to make sure that all of us in our room have an estate plan. Okay, chances you do, even if we're not wealthy. In California, if you die over $600,000 of assets, you do have to go to probate court if you don't have a foundational plan. So the probate process in California is about 18 to 24 months if there's no arguments or creditors. If there are, that process can go 3 to 5 years long. So what happens is businesses start to stall out, families can't figure out where to pay the bills from, or they do it by mistake, and then they have to tally up at the end when they get the court order. It's quite hard to unravel an estate plan that's been in court for 3 years. And so we want to make sure the plan kicks in. So what is the plan? What do I do? How do I avoid this? Well, I like to talk about I call a foundational estate plan. So a foundational estate plan will control the assets and the distribution. And there's really 4 components. 1, a pour-over will with a revocable living trust. So a revocable living trust, what is that? A trust is a legal document. It's on paper, now by email, but it's a document that's in a format that the state of California recognizes. So it's your signature. Oftentimes the lawyer will ask it to be notarized, and it has legal responsibility and legal obligation. But a trust allows you to say, I give 1/2 to my spouse, I give 1/3 to my son, I give the rest to my daughter, I give 10% to my church or my school. You get to articulate who and how your assets are distributed. This is very crucial if you have minor children, because they legally cannot inherit. So a guardian would have to be appointed to get their assets. Now you can articulate who that guardian is. I was talking to an estate planning attorney yesterday, and sadly, she had a couple that died in a car accident. They have a 3-year-old and a 2-year-old, no estate planning. Their children had to go to foster care, even though grandma lived a block away. The state did not allow grandma to take those kids. I thought that was a terrifying result, and I can't imagine the terror in those children or confusion for those children and the grandparent. That could have been avoided if they would have had a trust naming the grandparents as the guardian. Because once you die, this trust becomes irrevocable and no one can change it. So your wishes are permanent. And that's really how we get to decide who and when. Some children are not financially responsible enough to inherit. State of California says if they're 18, they get their money. In your trust, you can say they get money for health, education, maintenance, support. At age 25, they may get more. At age 30, they may get more, and whatever. You also can put conditions in. If they marry in the faith, if they don't marry in the faith, if they get divorced, all those conditions, you can control how they receive their inheritance. Now, the state of California does not have, as I mentioned, an estate tax. They also do not have what's called an inheritance tax. Some states, some countries do tax the people receiving their inheritance. Thankfully, in California, we do not have that. But many other countries do have that, and some states in the US have that. So we want to just not only know who gets our assets, but in what dollar amount, what value. Remember the old adage, fair is not always equal, equal is not always fair. And this becomes very clear when you're leaving your assets to your family. You really have to look at, when the dust settles, who is going to get what and when. My daughter has a terminal brain tumor. She's doing okay, but we've learned a lot about the brain since she's been diagnosed. And it's very clear now in the science that boys' brains are not fully developed until around age 30. Girls around 25. So if we're giving them our family business, or if we're giving them cash, they may not have the responsibility in their brain yet to even be able to handle it. That's why it's crucial to have your advisors in place. That's why it's crucial to have an attorney so your heirs know who to call. It is really, really important because sadly, I've seen this, grief shuts down the decision-making part of your brain. So when you're in grief, you are not making decisions clearly. You cannot, your brain will not let you do that. So you need to have advisors, close family members that you've articulated your wishes to, so they can make sure your estate goes as intended. And we need to plan for all the what ifs. That's really where life insurance is helpful. the asset allocation. You've done a great job working with Matthew and your advisor to build your wealth. We want to put the wrapper, the legacy around there. So really we can avoid any unnecessary expenses or taxes along the way. So 3 federal tax issues, including to the estate tax, there's a gift tax. So when I was younger in grade school, we would wait for recess. We would run to recess. And one of the playground apparatuses was a teeter-totter. I don't know if you had teeter-totters growing up, but you would pick a partner and they would sit on one side of the teeter-totter and you would sit on the other. And the hope was you would get someone about your same size and weight so you could teeter-totter evenly. Sometimes you got someone who was much heavier than you and they would plunk the teeter-totter down and you would be high in the air. Sometimes you would get someone lighter than you and you never got off the ground. So you always tried to get the person about the same weight so you had the evenness of that. And that's really what estate planning is. It's keeping the evenness in the legacy, in whatever balance you want to have it. And so we look at this about, should I die and give all my assets at my death? There's pros and cons to that. Or should I give assets during my lifetime? Because in the US, not only do we have an estate tax, we have what's called a gift tax. Now, California does not have this tax. They have a lot of other taxes, but they don't have a gift tax. And a gift tax is a tax that applies if you give during lifetime. So say I own a business and it's worth $1 million, and I want to give my son who works with me every day half of the business because at my death, my son's going to take over my business. That's what I want to do. That you can do. But if I give my son half ownership of my business while I'm alive, $500,000 is considered a gift. So when you give during lifetime, it's a gift. When you give at death, it's an inheritance. If I give over $19,000 a year to anyone, even my son, or $38,000 as both his parents, his father and me, we can give up to $38,000 a year. But over that, we have to file a gift tax return because it's subject to a gift tax. Now, a lot of people I've seen add their kids to their titles of their houses or their business. That technically is a gift. Now, I worked for the IRS for a short amount of time. I realized I didn't want to be on that side of the table, so I was on the other side of the table. Best practice would say you should file a gift tax return. Now, your CPA may say we have time to figure that out, but what I'm really getting at here is we really have to do our estate plan in a consistent legal manner. We can't just add our kids to the titles. It does allow them to inherit the assets, but it is a gift. And if there is an audit by the IRS, they're going to attach that gift tax and say, you late on paying that gift tax, and there can be penalties. So we want to work with an attorney. We want to do it in a legal format because that is the best legacy protection for you. So that's the gift tax. So everyone heard the numbers. I can give $19,000 to anyone every year, January 1st to December 31st. As a married couple, we can give $38,000 to anyone every year. That number does change from time to time, but this year it's $19,000 and $38,000. So if I am looking at my estate and say, I really want to start giving while I'm alive. There's many reasons to give while you're alive. One, they can measure your cells when you give, and they can see the heightened activity and the light in your cells by giving. You actually become healthier when you give. And so there's a lot of good in giving while you're alive, especially if you can give $19,000 away or $38,000 away without a gift tax return. The IRS says just go ahead and do that. So many of you might be doing that if you have grandchildren or your children, you may be giving them that. At New York Life, what we would like to do is look at where does that gift go once you give it? Can we create wealth for that recipient of that gift? If I'm giving my adult daughter $38,000, is there a place we can invest that for her wealth? And that's the advantage of giving again during lifetime. I'm building wealth at the next generation before I pass. And if I'm subject to that estate tax, it's a way to lower my estate. So then I can save that 40% tax. I'm building wealth at her level. It really does, overall generations, build exponentially the wealth of the family. So we would just, that is kind of a tax that we have. And then there's another tax called generation skipping tax. That tax says grandma gave to grandparents, or grandchild, they skipped their children. They skipped a generation. Well, the U.S. will tax that because they are looking for tax revenue. They want revenue to run the government, to do all the things that those tax dollars do, which, by the way, if you look up, they can't really tell you where all our tax money goes. There seems to be a little bit of a black hole there, but they are definitely going to look at a skip generation. So it's an additional tax in addition to the gift tax. Now, there are ways to plan around that. We typically would put a trust in place, and you would gift to a trust, and that will help ease that gift tax for the next and multiple generations down. And that trust is very common. They've been around the full 30 years I've been doing this. They'll be around for the next 100, 200 years. But it's a way to avoid that taxation and making sure that the multiple generations. And your trust can say many things. It can say, every year the trustee gives to my religious organization, or to my charitable cause. You can write that in your trust. So even if you pass, your wishes can continue to be honored. Okay. So these are the numbers I was mentioning here. This is the estate tax. As you can see here, the number has gone up, but I don't want us to rest easy on this. So the current Congress and the current president has put in a historical high exemption. And what I mean by that is we've never been able to leave 15 million and 30 million to our family without a federal estate tax, ever. This is the first year. Many years, in fact, for 10 years straight, that number was 600,000. So that meant if you died owning more than 600,000 and you weren't giving it to a spouse, or your spouse died, you both died, anything over 600,000 was subject to a federal estate tax. That tax is not only hefty at 40%, it's due in 9 months after you die. So the family is scrambling. If you had a business and your family's been living off the business income and you pass, where does that income come from? Does your child take over? Does your spouse take over? Do you have someone ready to go to work the next day to keep that income coming in? As I mentioned earlier, sadly, the statistic is it doesn't work. Only about 30% of businesses keep going. That is a conundrum for the family. They need to find that income. And if there's a tax, they need to find that tax in 9 months. If you have a business or real estate, you will have to have it appraised when you die. Right now, an appraisal in California is about $22,000 to $35,000. And they're not going to start without that money. So the family has to find that money fast. And you can't even find appraisers. They're still doing fire appraisals up by where I live. Pacific Palisades, they're still appraising those. So it's hard to find an appraiser. So your family loses time just trying to figure out what the tax is. They're trying to find out, do we owe a tax? And you know who's collecting their fees along the way? The CPAs, the estate planning attorneys. They have to collect the fees along the way. Do you know that if you pass and you've earned income that year, so say someone passes May 20th, and they've worked from January 1st to May 20th, they still have to file an income tax return for 2026. Even though they're deceased, their family still has to file an income tax return. Well, what if they owe income tax? Who has the numbers for that income tax return? Well, hopefully the family has a good CPA that they can rely on, that they can delegate that to, but the CPA will charge. I remember working as a CPA, our fees would double if the family had missing records. We would double our billing because it took so much more work for us. A plan could avoid that. Now, the other numbers on here, the income tax rates, I was talking to a gentleman earlier. We are at what feels like a very high income tax scenario. I think Matthew was mentioning this. Historically, though, we're not. Historically, we're in a pretty good tax scenario. You may have remembered in the news last July, Congress passed what was called the OBBA, the One Big Beautiful Bill. That bill kept our tax rates the same. Our tax rates were supposed to go up at the end of December of 2025, but that tax law put a lid on that. Now that tax law said, we know we're not raising taxes, so you're not getting the revenue, Congress, but don't worry, you're gonna get revenue from the tariffs we're putting in. Well, sadly, it's May of 2026 and the tariffs have not lined up. They change daily, and some of them are being considered unconstitutional. So that whole income stream isn't worked out. So the next Congress is going to have to tally up. Well, we didn't get the income from the tariffs. Traditionally, we got income from income tax and the state tax. I think Matthew mentioned there were years in the US that income tax was as high as 91%. If the next Congress, which is only 2.5 years away, looks at the deficit and says, where are we going to get money for this? It would be understandable, they would go back and say, we've had tax rates higher than what we have. Let's raise the rates. And unfortunately, it's the middle class that really gets crunched on that. The higher, ultra high net worth people, they move their assets out of the country. They create huge leverage by adding debt to their estates. They will move assets instead of selling assets and experiencing a tax, they'll lend against those. And then even they'll add a charitable beneficiary of their estate to avoid all tax. And then they replace the inheritance with life insurance. So my daughter knows Steve Jobs' son. That's what Steve Jobs did. So he had many, many dollars. And when he passed, his assets went to his charitable foundation. So the kids did not inherit direct, but they got life insurance, income tax free, and estate tax free because it was owned by a trust, and 2, they work for the foundation. So they have purpose. They have a purpose in life to continue their dad's legacy. And so they have tax scenarios that they do. One of the things that you could do is what's called tax harvesting or tax timing. Tax harvesting is your accountants, I'm sure, are doing this. It says, okay, I may have a capital gain because I sold my business, or I earned a lot of money this year, or I sold real estate. I really, really don't like the idea of paying this tax. You really can't get out of it, especially if you've already completed the sale. But what you can do is look at the other assets. Are there stocks that are at a loss that aren't going to rebound? Well, we can sell those and offset the gain. And a lot of times we'll rebuy the stock later or a similar stock. But that's how we get that final tax number lower. So hopefully your accountant is doing that. And if you would do any recommendation at New York Life, we would look at, do you have that opportunity? We would look at your tax return, like, do you have this opportunity? Because that's really how you do tax savings. You look at the 1040 and you move levers. It's hard to get out of a tax. But if you move levers, if you diversify in the buckets that Matthew mentioned, overall, you pay less tax. Okay, so current exemption I mentioned already, and you'll hear in the news that this tax law is permanent, but remember, it's only permanent until the next Congress. The current Congress kind of made a deal with everyone and said, we're not going to change the tax law again. But you know what wasn't in occurrence then? We thought the tariffs would line up. Everyone thought that that was the solution. It did not work. We've had other turbulent events since then that's costing the US government money they didn't have budgeted. So where are we gonna close the gap? It's gonna come from us. So we want to take this next 2.5 years, work with an advisor, reallocate our assets. So how many of you have taxable income? W-2, businesses, real estate, they're all highly taxed buckets. If we have 401ks, they're going to be taxed later. if we have a SEP IRA or a defined benefit tax later. If we can move some of those assets to a tax-free bucket, we will pay the tax today. Roth conversion is an example, but we won't pay it later. And if you do the math, you can come out ahead on that. And so we don't have a crystal ball. We don't know all the variables, but I can tell you, we watch the trends at New York Life. We watch where it's headed, because the planning opportunity is before, not after. So that's kind of the win of working with an advisor. Okay, so the 4 steps: protect yourself. That's the retirement planning that Matthew was talking about. Protect your legacy. That's having the estate plan in place. Tax reduction strategies, such as saving in a 401k, putting a SEP IRA in your business, taking tax losses to harvest tax gains. Timing your tax is a big thing. And then really just in making sure that you have all the documents in place. So in addition to the living revocable trust, I would encourage you all, if you haven't, do what's called a durable power of attorney. That says if I cannot, for some reason, make my own legal decision, I legally appoint this person to do it. So say and this happened, we had a son and mother go to JP Morgan. They were going to take out money for a roof on her house. The son and his mother went there many times over the years. And while they were there, the banker asked the son to leave the room. And a few minutes later, the banker and the mother came out of the room, and the son said, is everything okay? And the banker said, well, we don't feel comfortable taking the withdrawal today. And the son's like, well, my mother wants to, it's her money. And what had happened was, mother was answering questions of the banker inconsistent and very wrong each time he asked. And so he had concern about her capacity. And so he mentioned that to the son. The son did take her to the doctor, and she was declared with dementia, severe dementia that day. So she could not make her own legal decisions by law. So she did not have a durable power in place. So the son had to go to court and be appointed. And you would think it would just be a given, but it wasn't, because the other siblings were very confused, and they thought they should be part of that decision process. And it took a lot of time and money. And he was a business owner. He had to leave his business, go to the court. It was very disruptive. And unfortunately, the family just did not see that mother had lost her capacity. And so you want that durable power of attorney. So if she would have had that, the son would have had that document, and he could have immediately gotten the withdrawal as her legal representative. They would not have had to go to court. The other 2 documents I really encourage is what's called a living will. A living will says, I may be diagnosed terminal. Do I want to stay on life support? Do I want to be fed? Now, California has a very strict format for that. Sometimes you'll get that form in a hospital, but ideally you make that decision before you have to. I unfortunately was the person who had to make that decision for my mother. She did not have a living will, and the doctor looked at me and said, she's not going to recover. Do you want her to stay on life support? And I didn't know what to say. I have 5 siblings, and my dad wasn't there. So I just looked at the doctor and said, what would you do? And he said, we wouldn't keep her on it. And I don't know if that was the right decision to this day. I don't know if that's what my mom would have wanted. But I didn't know I was 22. And so I didn't know what to do. The living will say what you want to have happen. And then the other one is healthcare declaration, your healthcare proxy. So if you are, like during COVID, when you go on ventilators, you couldn't really tell the doctors what you wanted to have done for your healthcare. The healthcare declaration will appoint a person to do that for you. So especially if you have an elderly parent. In my case, I have one for my daughter. She's just 23. She has a terminal brain tumor. I don't want her making decisions about treatment. She's not equipped to do that yet. So I have the legal authority to do that. And you know how I got that legal authority? She got her MRI when she was 17 on her brain. When we got the results, she had turned 18, and the hospital wouldn't tell me what they said. Now, if you've ever waited for MRI results, it's nerve-wracking. And they said, put your daughter on the phone. I'm like, I'm not putting my 18-year-old on the phone with an MRI that might say her brain tumor grew. I'm not doing that. So I had to run and get a medical power of attorney. It's very stressful because it took me 3 more days to hear the MRI results. Thankfully, they were good, but it was very stressful. It literally was because she was Friday night, she got the MRI, she was 17. On Tuesday, when we got the results, she was 18. And so again, 18-year-olds really don't even have, they're still very young, especially in California, they're very young at 18. So I'm gonna stop there. We've gone quite a bit of time. I think, Matthew, maybe you and I, we could just open it up for any questions. If you have questions, glad to answer them. And hopefully you had some valuable information here. I would encourage you, I'm not gonna ask you to raise hands, but I would encourage all of you to get your estate plan completed, try to get it done, feel sure it's up to date, and that it really aligns with how you and your family want your assets to pass. Just make it a goal. If you know before you go to an attorney how you want your assets to go and who's going to be in charge of it, it will only be usually 2 meetings with an attorney. The first one, so they get to know you, they have to do that by law. The second one, to sign. Now, that is really a short amount of commitment for a very good estate plan. You can change them. If things change in your life, you can still change them, but you want it in place today. I talked to a couple yesterday. They went through the process. Their one trust that they paid $6,000 for will save them $38,000 minimum. So it is an investment, but it's an investment that will save 10, 20-fold on the other side of it. Okay, so I don't know if there's any questions or.
Awesome. Well, if no other questions here, ladies and gentlemen, I guess we could just say thank you once again. Really looking forward to having a little bit more detailed discussions with you all. Again, I don't want this to also be looked at of we're going to sit down with Angela, Matthew, myself, and we're looking to do business. We see there's a lot of miseducation out there. We also see a lot of questions not being answered. I'll even speak on a scenario myself. PetSmart, real scenario, that's one of New York Life's corporate clients. I typically do like once a month, like an employee engagement with all their employees around the country. And the questions that I receive just on a Zoom meeting with employees around the country with this great organization, PetSmart, it's sometimes I'm like, let's go into ChatGPT. Let's look at a follow-up question.
Be careful. ChatGPT is very wrong in many cases. If you are using ChatGPT, please go to the source. It lists the source. If it's not the Internal Revenue Code, question it.
Right. So we're here. I'd love to spend some time, and I want to thank our president here. Right? Thank you for spending the time. And I don't know if you want to say a couple of words for the group, but on behalf of Angela and myself, we hope that you've gotten some value, some great education, and please, any questions that you have, we're here. I spent the whole day down here in Newport. I come here at least once or twice a week. My main office is up in Glendale, but don't let that be a reason not for me and myself to come down here. And I've had a real pleasure, right? Thank you all for being here today.
Thank you.
Yeah, thank you.